Well, good morning, friends. Welcome to our ongoing series of fireside chats. Today, we are thrilled to feature an amazing digital asset fund management company. If you're doing anything in crypto or have an interest, this is a must tune in. 3iQ is a world-class digital asset investment firm that specializes in all different facets of crypto investing. They were the first to launch Bitcoin and Ethereum exchange-traded products, ETPs. Remember, ETP is a closed-end product and it's different from ETFs. They were the first regulated digital asset manager in Canada. They launched their Bitcoin and Ethereum ETFs back in 2021. Also, they had one of the first industry's first SMA model portfolio solutions for digital assets. But the true groundbreaking product they are featuring today is a multi-strategy fund named Digital Access Portfolio. This is a multi-strat fund that allocates to 9 different strategies featured on their platform. Think of them as Millennium or Citadel of digital assets. Today, you will learn about their platforms, investment philosophy, and really what makes them best at what they do. Our speaker today are Pascal St. Jean and Louis LaValle. Pascal is the president and CEO of 3iQ. Simply put, he is the ultimate disruptor of industries via use of technology and scale. Pascal is a founder of several companies, too many to mention here. He was an active investor and strategic advisor to over 25 of the fastest growing companies in Canada. He got involved in digital assets over 8 years ago, and he's been transforming the industry ever since. He has also become a thought leader in the space and has acted as an advisor to several companies. He was one of the youngest recipients of 40 Under 40 awards. As president and CEO, he is overseeing the global growth and expansion of 3iQ. We also have Louis LaValle, vice president of 3iQ Hedge Fund Solutions. Louis has over 20 years of experience in hedge funds, private equity, and digital assets investing. Louis has worked at several global investment firms, including Neuberger Berman, Legg Mason, and BNY Mellon. They all happen to be clients of Fundstrat as well. My partner and head of research, Tom, will give an opening remarks. As you know, before Tom became a top-ranked strategist, he was top-ranked wireless analyst from mid-90s to GFC, analyzing leading technology investment companies like 3iQ is really his bread and butter. Our moderator today will be our crypto extraordinaire and head of crypto research, Sean. There will be a Q&A at the end of the presentation as usual. You can ask a question using Q&A button at the bottom of your screen. As usual, we will send out replay information as well. If you would like more information regarding 3iQ, including ways to invest in their funds and/or company, please contact your sales rep or email us at inquiry@fundstrat.com or inquiry@fsinsight.com. I would like to thank Pascal and Louis for taking time during their busy schedule to do this with us. And finally, on behalf of Tom, Sean, and all of my colleagues, I would like to thank you for your support and business. I will now turn the mic over to my partner, Tom. Thank you very much.
Hi, good morning, everybody. I am really glad to make a few comments before Pascal St. Jean and Sean have a fireside chat. If you have not allocated to digital assets yet, I think you are missing out on one of the most important opportunities over the next decade. We've written extensively about why you should have exposure, but most importantly, if you're doubting whether crypto is a bona fide asset class, it's already established. It's more than $1 trillion of assets under management today, supported by juggernauts like BlackRock and Fidelity. So it is already becoming something that is sort of supported by a broadening financial system. I think that the mistake someone makes is that they can try to do this simply by buying just a little bit of Bitcoin themselves, or they'll trade it. But what we found is that over the cycle, you're better off really trying to find somebody who has a lot of experience. And this is where 3IQ comes into play. I mean, these guys are one of the largest asset managers with more than $1 billion of AUM. But the product that they're spotlighting today, which is their DAP, I think is a very smart way to get exposure. They're giving you a way to have multiple strategies, giving you exposure to crypto, but each of these is managed by some highly skilled managers, including like Hyperion, Decimus, et cetera. And overall, and this has been shown from our institutional clients who know this, that when you have uncorrelated portfolios and each of them managed by an expert, you overall actually start to get better returns with lower volatility. And I think that's what you're going to see and hear about today. So you've got a great team over at 3IQ. Pascal's pedigree is really impressive. I mean, especially in Canada, he has been really an angel in some of the most important companies there, including Globe and Mail. And I think this will be a good just conversation for you to hear, not only about what these guys offer, but why you should be investing in crypto. So with that, I'm going to turn it over to Sean.
Thanks, Tom. I think that was the perfect intro and a great segue to Pascal and Lou, who I'm going to bring in now. They're going to give us a quick rundown on 3IQ, talk about what they're building, maybe talk a bit about their origin story, and really dig into QMAP and ultimately DAP here. Welcome, gentlemen. I'm going to share my screen and share the presentation that we're going to reference over the next few minutes. How's everybody doing today?
Excellent, and great to be here. Thanks, John and everyone, and Tom for that great introduction. So again, I'm really looking forward to chatting more about what we've been building out here and having a fireside chat around answering questions around the space and around some of the innovation we're seeing over this coming cycle. But I want to share maybe a little bit more in terms of our history. I think John did a great segue, but basically, if you want to scroll down, Sean, just to talk, if we could just introduce the firm here. So essentially, if we go to the origin story of 3IQ, we were founded in 2012, but really our growth and the shaping of our DNA, that's perfect, thank you, really took place between 2017 and 2020. I think John alluded to this. I think what we were able to do is to work over those 3 years with the Canadian regulators to forge a path in creating clarity here in Canada. The story could go on over dinner and drinks, but we tend to say that, well, working with the regulators over several years, we're able to launch the first ETPs for Bitcoin and Ethereum here in Canada. From there, we continued our expansion and cross-listing those products in different jurisdictions, and eventually the launch of our ETFs in 2021. But really, that origin story is what led to today's DNA. And we like to say our focus today as a firm, as a native digital asset manager, and again, one of the largest in the industry, is we like to launch products that we say safe, secure, and simple. And what do I mean by that? Well, when we say safe, it's choosing the right assets and strategies. There's a lot of work that has to go into putting in the work to launch products that meet those criteria. The second is secure, and Lou, our Executive Vice President of Hedge Fund Solutions, will tap into that a lot. But essentially, using regulated institutional infrastructure, and how do we bring sort of a lot of the things we're used to into TradFi, and how do we bring them into the digital space to create security and institutional grade infrastructure for our investors. And finally, something we're quite proud of, which is what we call ease of access on a global scale. As you can imagine, each jurisdiction globally has different regulatory bodies. Every regulator sees crypto and digital assets in a different way. So there's a whole suite of complexities of getting an investor in Europe, in the US, in Canada, in Asia, to be able to access products on a global scale. And there's also complexities in where you build those products in a safe, secure, simple way. So 3IQ really focuses, because of that's our DNA, on these 3 things. And so quite proud of that. And so as we looked at where's the firm evolving to? If we move to sort of the next slide, that was kind of our history, where we moved on today. So after the launch of our ETPs and our ETFs and some cross listings, we really sat down as a team and said, how do we continue scaling as a firm, and how do we continue to scale our mission statement to as many investors as possible? And two things came to mind. The first is we want to continue that global expansion. We are, of course, have roots in Canada, but today we have a team in the US, in Europe, in the UAE, and now thanks to our association with Monex Group, having concluded a transaction with them back in April a few months ago, we're now part of the Monex Group family. They're a publicly traded Japanese company with over 2,500 employees globally, with entities in the US such as TradeStation, Japan's largest crypto exchange in CoinCheck, and now one of the world's largest asset managers in crypto, of course, 3iQ. It's a wonderful group to be a part of. And by being able to collaborate with those other entities and having the backing of a firm like Monex really has allowed us to penetrate the institutional market on a global scale. So that was the first thing we wanted to do, is find that right partner, and we were able to do that. The second thing was really about sitting back down and saying, how do we continue forging innovative paths? And when we sat down as a team, saying two things came to our attention as the future growth in digital assets: staking and hedge funds and actively managed hedge funds. And so we went out and invested serious dollars and energy and commitment from 2021 until today, and you'll hear the full story from Lou. But again, very proud to have announced the first staked Ethereum ETF that was launched last year and has been a great success for us. So staking is well on the way for 3iQ, and we're a global leader there. And the second was the announcement of launching the first managed account platform for hedge fund solutions. And with that, I'll turn it over to our Executive Vice President of Hedge Fund Solutions, LaValle, who's really the architect of this amazing platform, to talk more about our DAP product, which we're coming to market with as we speak. So Lou, the floor is yours.
Thank you, Pascal. So just a quick background on 3iQ Hedge Fund Solutions and kind of how it started. So we're a specialized team that sits within 3iQ, and our team is made up of a very diverse group of both investment and operational professionals, many of whom have years of experience in both traditional finance and within the digital asset space. We really started building out the foundation for this business back in 2021. And the goal at that time was to really build out an investment platform that was specifically designed to offer actively managed solutions that an institutional allocator or a private investor would feel comfortable investing in. And based on all of our past experiences coming from blue chip financial organizations, we put a very high priority on establishing an operational infrastructure that would mirror what you'd find at a large, sophisticated asset management firm in the traditional space. And so that meant really creating what we believe to be the highest standards around due diligence, risk management, and transparency. I think we're at a very unique inflection point in the digital asset markets. The market has matured a lot in the last several years, and we all know and heard of a number of the large institutional players that have been stepping in and adding that much needed credibility and structure that was missing for years. And I think what's interesting about that is, as these institutions have come in and built out infrastructure, that's led to an influx of investment talent. And that talent has come from some of the best organizations that are in the traditional space. And the individuals that have come over to digital, I think, represent a new wave of active managers that are really, they're leveraging their expertise that they designed in the traditional markets, and they see a new opportunity to exploit what are very inefficient, irrational, and untapped alpha opportunities in the digital asset space. And we think that this isn't a window that's going to remain open indefinitely. The opportunity really to capitalize on this is now. Philosophically, our mission or our goal at HFS is pretty simple. We want to find the world's top digital asset managers. We want to allocate capital to them, and we want to offer our investors a diversified, secure, and transparent way to access these opportunities. Just flipping to slide 16 here. Thanks, Sean. So when I look at our investment platform, I think there's really two areas that we focused on that really set us apart. First is all of our investments are made through separate accounts, And those separate accounts are powered by our managed account platform called QMAP. And just so people know, a managed account, what does that mean? We're setting up a separate account and investing directly with a manager versus investing in their commingled fund with all the other limited partners. And this is a really unique setup because it allows each manager to basically trade our own capital, but they don't control it. They can't withdraw the capital or move it anywhere. We own, 3iQ owns and controls the accounts. And so there's a lot of benefits and investor protections that are inherently built into this structure. And I'd say one of the main ones is, since it's our account, we can really mitigate risks like fraud or managers running away with funds. It eliminates a lot of the liquidity issues that you may have heard about with hedge funds in the past, like gating or side pocketing. We also gain full transparency and oversight of the day-to-day account activities with the managers. We can monitor P&L. We can see their underlying assets in real time. We check our position limits. And that really makes it easy for us to adjust allocations or, even if necessary, cut risk. So today, in my mind, what we've built on the managed account side, QMAP is really the only buy-side managed account platform in our industry. And I think that really is a unique competitive advantage. The other competitive advantage that we have in the space is really our process for finding managers and finding talent. Being in the industry for over 10 years, we really have a deep set of roots, and that gives us access to a network of all the major exchanges, custodians, prime brokers, market makers, and those individuals and those firms give us a very strong pipeline of potential investment ideas. That said, we are of the belief that this is a business of a few good people. And so today we are tracking around 300 managers globally, but less than a dozen of those have been approved for investment. We get the question a lot from folks. They'll often ask us, what's the first thing that you look for when you're looking at a manager or evaluating a manager? And surprisingly, we look at performance last. We typically start with the biographies. We want to know where they've worked, what they've accomplished, and whether they're truly focused on being the best in their strategy category. We're really trying to find that clear competitive edge. And then after that, we do the typical underwriting. We dive into the numbers. We dissect the track record. We really want to understand the sources of returns, the risks that were taken, whether the process was repeatable or not. And so as a result, when you look at our approved managers on our platform, you'll find that they all have exceptional track records and pedigrees. And on the screen, you'll see that many of them come from some of the most reputable investment firms in our industry, firms like BlackRock, Citadel, Brevin Howard, to name just a few. And so this is what I would say is part one of our team's value add, really finding who we think are the best of the best across our industry, and then creating institutional grade investment structures that are addressing all the key concerns that our investors have. The second part is product engineering. So how do you mix managers and strategies together and create an attractive risk return profile, and then provide investors access to that in a simple and efficient way? And on slide 22, this is really where our digital access portfolio, or DAP, where that really comes in. Just as a summary, the DAP is our flagship solution in the space, in the actively managed space, and it invests exclusively via the 3iQ managed account platform. We built the portfolio because we really believe that this style and this approach will make it a lot easier for investors to get broad access to actively managed digital asset strategies over the long run. And I think there's two reasons why this should be an investment consideration today for any investor that wants to get access to actively managed strategies. The first is, we believe the best way to access this market is through a multi-manager, multi-strategy approach. The crypto markets are notoriously volatile. Opportunities appear, they disappear, it happens very quickly. And with that, different strategies perform better or worse at different times. And so diversifying across multiple managers and strategies is what we believe to be a more prudent way to allocate dollars to active managers. With this approach, we also reduce single manager risk, and at the same time can capture a broader range of opportunities. And we put all this together in a single investment structure. So think of it as sort of a one-stop solution. And the goal is really to deliver something for investors that balances upside market participation risk management or risk mitigation, and also just overall portfolio diversification. So that's the first thing. Second, building a diversified portfolio of multiple managers and strategies can be extremely challenging, especially if you're doing this on your own. There's hundreds of investment managers in our market. There is hundreds of strategies. Each of them have their own nuances and risks. And if you're an average investor, sifting through all those and conducting what we believe to be the required due diligence, it's incredibly complex. There's also crypto-specific risks that you have to consider. One of the biggest challenges in our space today is operation due diligence and risk management. We've seen the importance of that during events like the FTX collapse in 2022. And so the DApp is really built to focus on mitigating these risks. As I mentioned, 100% of the investments are made through our 2MAP managed account platform. And through that platform, we're leveraging top-tier investment infrastructure, which significantly minimizes the counterparty risk that you typically find in the crypto space. So all of that is passed down to the investor as just part of the process. And then on slide 23, from an investment standpoint, our goal really is to deliver consistent returns through all market cycles. And we want to do that by being able to be positioned to capture gains during bull markets, but also safeguard capital during down markets. That compounding effect is how we think you can generate really outsized returns in this space in a very safe and secure way. As a first principle, as a result, our priority is to avoid any permanent loss of investor capital. The asset allocation of the digital access portfolio, the DApp, that's built on a strategic asset allocation model that we actively adjust. And we do that based on our macro outlook, specific views that we have on certain types of digital asset strategies, and just a general investor sentiment on a regular basis. Since the model's inception, which was January 2022, the result has been high absolute returns, but low correlation to traditional assets, and also lower volatility and lower drawdowns relative to a buy and hold long-only digital asset portfolio. Within the portfolio itself, I'd say managers play one of three roles. Their job is either to grow capital and meaningfully participate in those bull markets when we have them, or they're trying to protect capital during periods when markets are in a downturn. Then there's also managers in our portfolio that are there really to provide an uncorrelated return stream, regardless of where the market is or where we are in the cycle. And so we categorize those managers into 5 strategy categories: long biased and long short, quantitative, relative value, and event driven. And you'll notice that these are the same strategy categories that you'd find in the traditional hedge fund world. There's no crypto speak here. This is a very similar portfolio construction that you'd find from a traditional multi-strategy investment manager. Currently, we're allocating across 9 portfolios, and those 9 portfolios are managed by 7 managers. If we flip to slide 23, I just wanted to go over a few of the benefits that I think the DApp can provide to investors, whether you're trying to solve for problems with your traditional investment portfolio or your digital asset portfolio. On slide 27, I'd say the first is capital appreciation. So since inception, going back to January 2022, on a pro forma basis, the portfolio has outperformed Bitcoin by over 20%. It's also beat public equities by over 40%. So this can actually provide you with some really attractive compounding of returns. On slide 29, I'd say the second benefit is capital protection. So if you go back to the inception of the strategy, this portfolio has consistently provided downside protection when we hit the worst periods of the digital asset markets. It's outperformed in 14 drawdown months. And during those drawdown months, the average drawdown for the broader crypto market has been minus 22%. Ours has been around minus 2.5%. And then just flipping back to slide 26, sorry, Sean, that we're going backwards, but the third sort of benefit in my mind is diversification. And if you look at the portfolio since inception, we've really been able to deliver an attractive risk-adjusted return. We think about everything in terms of risk-adjusted returns, where we're delivering a return with some level of volatility. So when you look at the returns of the DApp versus, let's say, an equity portfolio, forget about digital assets for a second. We've been able to actually create an equity plus return with a similar volatility profile, but the actual correlation and market risk, it's about 50% of traditional equity. So we think that there's a lot of versatility with this portfolio, whether you're trying to solve for crypto risk or traditional market risk. And I think the last point I'd make, just wrapping up on slide 33, is the structure of DApp is really unique. So we don't charge any additional platform fees or extra layer of fees for our limited partners. The portfolio actually feeds directly into the QMAP platform. And so investors are effectively deploying capital into a discretionarily managed portfolio, and that portfolio is allocating directly across a diversified set of opportunities without paying a premium. And so another way to think of that is you're getting all the diversification benefits of a multi-strategy, multi-manager portfolio. You're getting access to the best managers and strategies, but you're not paying an added expense for that. So with that, I'll pause there and I'll flip it back to Sean.
Yeah, I think in summary, before we go into the fireside and Q&A, I think what you just shared there, Lou, is a perfect example of our core values and our brand promise. When I talked about, safe, secure, simple, the amount of work that you and your team have done on manager diligence and really exploring every possible manager on a global scale. When we talk about the safe, it's there, right? So when you're saying you're selecting, 9 to 12 from 300, tremendous amount of work has gone there. The secure part, again, talking about infrastructure, I think the QMAP platform that Lou talked about really is institutional grade. A lot of tri-party agreements were done to really protect assets post FTX. So everything is sitting on a robust institutional infrastructure. And then the simple part that we always try to keep promise is the DApp portfolio is how do we give you, the investor, the easiest form of access to all of these strategies and a portfolio that is designed to really outperform in a risk management way. So super excited to be announcing this. And it's been a lot of work over the past few years and super proud of the team for what they've done. So Sean, I'll pass it to you for the Q&A section.
Yeah, huge congrats to the 3iQ team for getting this off the ground, and really great overview. I think it was very informative. There are a few things that I think are worth unpacking for the audience. Also, real quick before we get into that, I don't know if everybody knows, but there were some bugs around our remote sharing on Zoom. So if you didn't catch any slides, don't worry. We did send this deck out to everyone. Make sure you review it, spend some time with it, and even if you have any questions, definitely feel free to reach out. But again, great presentation. I think where I'd like to start is just really sussing out the differentiators for DApp. So when you think about DApp high level, if you tell somebody you have this allocator that's managing to other managers, sounds a little like a fund of funds, but you and I both know that this is most definitely not a fund of funds. So perhaps if you could just dig into the differentiators for DApp and really drill down on what makes this a differentiated offering.
Yeah, sure. And I think I mentioned it a few times, and I think it's important because it's not familiar to all investors, but I think really the key differentiator here versus what you'll see from a traditional multi-manager, multi-strategy, and I cannot stress this enough, we will not allocate as an LP into a commingled fund. 100% of our investments are exclusively investing through QMAP via managed accounts. So that is very different than a fund of funds. I would almost say that this, you can think of it almost as a fund of managed accounts. And that's a real, I think, important differentiation. And really, I think it's a game changer in how we've been approaching the asset management space versus some of the others. And not to let's talk about fund of funds just for a second, not to rain on the parade, but they have a bit of a reputation in the space because there's an extra layer of fees, right? And those fees can actually erode returns over the long run. And I think the benefit that investors get in a fund of funds is you have access to top managers and you have diversification. Those are all really important things when you're investing in the hedge fund space, but there's a premium, and that premium isn't always justified. And frankly, there's been scenarios in the traditional world where fund of funds have not delivered on that promise. We all remember the days of, Madoff, for example, where those sort of high profile failures are not what investors are signed up for. So with DApp, our goal is really to change that narrative completely. When you're investing, you're not paying an extra layer of fees. You're getting all the diversification benefits without paying that premium price. Asset allocation, research, due diligence on the managers. That's all part of our process. And so we don't charge for that. There's no extra tack on. And I mentioned this earlier, there's a number of benefits around owning and controlling the assets and having full transparency. Those are really big benefits, but there's others, right? So when it comes to fees, we get to negotiate with our managers. We have the opportunity to negotiate fees in terms of our managers. And if you're investing in a communal fund, that can be really tough. They're not always inclined to offer fee reductions. And when you're in a separate account structure, not only are you negotiating price and terms, but you can also customize the strategy. So there's a number of accounts on our platform, strategies on our platform, where we design the strategy to align with our top-down views. And we also wanted to implement things like capping leverage, because that's something that we typically shy away from. And also focus on areas that we thought were really, really interesting, more concentrated themes or assets within a manager sub-strategy. And so I think that's an important distinction, that customization and that ability to have better terms and better pricing. And so the question is, well, how do you make money then? Our platform is structured where we share in the management fees and the performance fees with our managers when we structure each managed account. So we're fully aligned. If they make money, we make money. If they don't make money, we don't make money. And so that's something that I call structural alpha. And I think that is sort of the opposite of what I also call structural decay in fund of funds, where that extra layer of fees can actually erode returns. We actually think that it can add to returns over the long run, and that eventually would just create better outcomes for our investors.
Great breakdown. And I'm glad you highlighted the alignment of incentives there, because certainly you do have an outsized amount of skin in the game relative to perhaps a fund of funds that does capture that 2% on top of their other layer of fund fees, GP fees. So who's the customer here? What does the customer profile look like? Obviously different funds have cater to different LPs. You have venture for longer tail bets. You have liquid funds that are, cater to those who are insensitive to, or more sensitive to duration risk, but still are quite adventurous. Who is the DApp customer here?
Absolutely. Happy to jump in on this one here, Sean. I mean, our mission, even with our original products, which was to give access to as many people as possible. So when we launched the ETFs, it gave access to Bitcoin and Ethereum to a population that, maybe weren't comfortable in accessing spot assets. But for DApp, it's the same concept, but at the institutional level or at the more sophisticated investor level. So we really have been getting a lot of traction with two key investor types. The first is the crypto investor. So someone's already allocated to the space, maybe in spot via ETFs or even self-custody and or venture, and is looking to diversify into something that's a little more liquid and a little more risk managed. So again, spot's liquid, venture not as much. So looking for that, to allocate more to the space, but in a diversified way. That definitely the DApp and the QMAP platform are geared for them. The second is the opportunistic investor. It could be someone who has invested actively with hedge funds and looking for that next, leg of innovation in the space, like what's next for hedge funds in general beyond crypto, who really value liquidity and want to gain exposure potentially to this asset class in a risk management way. That everything we've built, from manager diligence to the platform to the DApp portfolio and eventually the DApp fund, is designed for that type of investor.
That's great. I think that's a great breakdown. Perhaps now we can talk challenges. So could you maybe just fill us in on some of the challenges you guys have had to overcome in building maybe crypto products more broadly, or you can be specific about something specific to SMAs or DApp specifically, but maybe just talk through some of the key obstacles you guys have had to overcome in building your suite of services out.
Yeah, I'm happy to talk at a global business level, and Lou could jump in on the operational front, because there's challenges, of course, on a weekly basis scaling a business in this space. I think for us, really, sort of our origin story describes a bit of what we've become really good at, and those are all fundamentally the challenges of scaling a business in this space. The first is really finding ways to collaborate and educate regulators to be able to innovate, to do product innovation. So again, our platforms our institutional grade, fully regulated. Our products are regulated in different jurisdictions, and our ability to give access to people is fully required. So that's one where to be able to understand how to have those conversations is uber critical. The next is really, like Lou mentioned, I think in a post FTX world, I think where we were meeting family offices and investors and others pre FTX, it was either unsure about the space, so they weren't as educated as they are today. And I think firms like Fundstrat have been doing a great job at educating, the institutions. But it was either unsure about the space or what are the returns, right? They were just seeking returns and not really looking at the risk involved in the counterparties because they're so used to not having to look at that in the traditional space. And unfortunately, FTX set the world back a bit. But I think what it did is it gave a shot of a 3IQ to really demonstrate what we're built of. And so today, the challenges of doing the deep work and having the expertise like we have in our team and the team that Lou's built on his hedge fund team to do the deep dive, uber critical. And then the last is really be able to understand global settlement and global money flows and global access. Like for a crypto firm, like I used to say, we're a Canadian digital asset firm. Yeah, that's where we started. Canada is niche and crypto is niche. That's niche on niche. So we had to expand globally. And for that, we had to understand how to service investors and partners on a global scale. So anyways, our feedback to any company in this space, if they really want to get serious to us, is regulatory conversations and be able to influence and work with regulators, doing the heavy lifting and the diligence to protect investor capital. And then the third is finding ways to streamline and reduce friction for investors. And finally is trust and reputation, which I think we have a strong reputation in the space. And again, aligning ourselves with a company like Monex adds to that trust at the institutional level. So I'll leave it there, but Lou could talk about operational challenges that we're seeing in real time.
And those are all great points, Pascal. I'll keep it really, really short. I think I'll just say that our industry is always pushing innovation, and we almost push innovation too much, I think, sometimes on the investment operation side, because we lose sight of the really simple things that matter to investors. And you had mentioned it earlier, but when we first started to build out our platform, and we were thinking about custody and counterparty risk and who we were going to trade with, we went back to the old playbook and looked at how did we do this in the traditional capital markets. Let's have tri-party collateral management systems in place. At the time people were like, why would you want to do that? And then FTX happened, and it was like, well, that's why you want to do that, right? And so what's great about I think the industry is there's always everyone's commercial and trying to push forward and really I think innovate, but at the same time it's like let's keep it simple and just solve for the sort of the easy things first. So that's my only additional comment.
Yeah, no, that's great. So you guys were just speaking to parallels between TradFi and crypto and some of the holes or some inefficiencies in terms of where crypto does not really meet up to the expectations in TradFi. I was hoping maybe you could just break down the active management market in crypto, how it looks like, how it's evolving, and what challenges exactly is active management solving for, as opposed to more passive allocators that just want to buy and hold Bitcoin ETFs.
It's a really good question, and candidly, there's a lot of art and science that goes into sort of mapping out the active management landscape. The way that we sort of look at it is through layers, and I think the first layer you have to break down is manager skill sets. This is pretty unique to crypto or digital assets. So we have managers that are traders, we have managers that are venture, and the reality is they're all executing their strategies in a 24/7 market. And so it's very unique to see sort of both of those skill sets sitting next to each other, and you have to really sort of decipher who's who and who's doing what. You wouldn't normally see a long only buy and hold private market strategy sitting next to a long short hedge fund strategy. So I think the first is skill set. What are they actually trying to do? And then liquidity. Are they running a liquid portfolio, or are they locking money up for 10 years? And really the way our focus in the space is primarily liquid strategies. So think of it as sort of long only managers, hedge fund managers, or hedge fund strategies, or DeFi yield oriented strategies. And then everything beyond that, in my mind, is maybe a 1 year plus lock is really venture capital. So the way we sort of think about it is you have your directionally long strategies. Those can be long only or long biased. Managers that are executing those strategies, they may not be as trade oriented, but they may be applying quant principles to take advantage of all the market inefficiencies. This is also the category where you see the venture capital like firms stepping in, where they're potentially building long exposures in tokens, sometimes equity or early stage protocols. We do see some private deals here and there that could include token warrants or options. So that's kind of bucket one. And then bucket two is directionally long short strategies. And those are your trader teams, right? They're either doing that on a discretionary or a systematic basis. That's where we find trend following and momentum, signal-based strategies. Managers are trading more than just spot, they're trading options, futures, perpetuals. And then I'd say the third bucket is really market neutral relative value, right? Those are those managers that are market makers, high frequency traders. They're trying to, like in the most simplest case, go long spot, short the perp, and collect the funding rate, and take advantage of these arbitrage situations. So those are, I'd say, the general categories on the liquid long only side and long short side. Then there's yield strategies, which are more, it could be on chain, it could be off chain, but staking, lending, DeFi pools. In my mind, that's really that's the universe. The problem is I can't tell you what the AUM is in each one of those categories like I could in the traditional markets, because there's no database that exists that tells you who's doing what and how much they're managing. There are the Prequins and the Vision Hills out there, and I think that they do a great job. But Prequin will tell you there's about 1,100 crypto hedge funds out there, and that's grown probably 6x over the last 5 or so years. They'll also tell you that 30% of those managers are only investable and the rest are kind of not. So we built our proprietary database from scratch. We track about 350 managers today. Estimate wise, I'd say about 80% of them are managing below 50 million of AUM. Most have track records in the 3-year-ish range. Very few have 5+ years. So what I just described is an emerging manager. So we view the whole space as an emerging manager market. I do think that the silver lining is the teams that are out there that are sub 50 million. There are a subset of really high quality teams that are building out robust operations, risk management processes. They're going to be $500 million managers once the allocators come in. But it's just a matter of time before that happens, and I think that until then, we're going to be sort of stuck with this AUM problem that if you speak to any manager, they'll tell you exists in the space today.
I think what we're seeing here is exactly is that renaissance of hedge funds that we're seeing here. The same thing about 20 years ago. It's the emerging managers, these major opportunities, and we know that this is still very early in the space, but we always want to be first in the game, which we are. And so we're ready to capture the upside. There's some really exciting opportunities ahead, like Lou described. So quite impressed by the caliber of people we met.
It's great to hear. I think John is back. He has a couple questions for you guys. Hey, John.
Yeah, thanks for that, guys. I'm just getting questions directed to me to ask you. So I think you briefly mentioned about the rebalancing, Louis. How often does that take place?
So we run a strategic asset allocation model, and we rotate that model. It's certainly not static, but it's also not automated. There are a lot of things that go into us making our strategic allocation moves. We tend to formally look at that model every 90 days, but our goal is not to turn over the portfolio every 90 days. We really do it more from an evaluation standpoint. I would say in the current environment that we're in right now, we're likely making 2 to 3 changes a year with our allocation, but we're not making big changes, right? It's a strategic model that has ranges in place for every strategy that we invest in, and then we'll make tactical tilts. So, for example, going into 24, given the fact that we were sort of in the first leg of the recovery coming out of 2023, we wanted to take on a little bit more portfolio risk, a little more beta. So we moved our long bias portfolio allocation from 25% to 30%. Long short came down 5%, and then everything else was more or less constant. So you're not going to see these big moves. We're not trying to time the market. Ideally, the manager is making changes as the opportunity sets evolve.
Okay, so in that spirit, you're not having any say on how these 9 guys are managing their portfolio?
We pass 100% of the discretion off to the manager to not only manage the portfolio, but risk manage the portfolio. We add
Okay.
layers of risk management on top.
Top.
On
Okay.
top, we can always cut risk in a separate account, but we're not trying to be the, we're not trying to doubt the manager, right? We spend
Right.
a lot of time getting, underwriting them for the portfolio.
But I mean, if there's a situation where one of the 9 has a huge drawdown, I mean, do you have a mechanism where you yourself have a drawdown on each fund? If one of the 9 has a 30% hit in a week, can you kind of go in and just say, okay, we need to cut loose because they have hit our drawdown per fund? Do you have that kind of guidelines?
Absolutely. Not only do we have that guideline, but we're getting to that hit before it hits 30%, right? We have a risk management system that we invested quite a bit of money in, that we've integrated across our entire platform. And so we have notifications in place if there are certain drawdown limits that are hit. And we have a certain drawdown tolerance for every strategy category, every manager and sub-strategy. So ideally, we're getting to them before they hit that level. And I can also say that we have the ability, and we've done this actually, we tested this in real time to liquidate the entire portfolio and cut risk. And it'll take us, I'd say, for about 90% of our platform, a little over 90%, we could liquidate the entire platform within 24 hours without any slippage on performance.
Right. So, do you also have a percentage limit that you would invest with each of the 9? Meaning, like, you will not be more than, say, 10 or 20% of their AUM?
It's a really good question. That is less relevant for us because we have a separate account. Because we're not sitting next to other investors and we're not necessarily holding the bag. That was my point around, gating and right. It's our assets. So if they can't do anything except trade the assets, right?
I see.
Now it's important to know what their AUM is to see if they have, a certain customer base. But if they're managing 50 million and we wanted to bring 50 million to the table, our 50 million doesn't sit with everyone else's. It sits just next to ours.
I see.
Our assets.
So what you do with your money is not going to impact what they're forced to do. So, okay, very good. And then I got 2 more questions. Are you like, is it fairly easy for a fund manager to get kicked out of the platform because their performance is not good?
It's another great question. I think the short answer is it's hard in that we spend 3 to 6 months doing the underwriting. We have a 450 question DDQ that we send out to all the managers that we put to investment committee. And then we do this extensive underwriting. So we're really diving in here. So if they're drifting from style and it's pretty noticeable, yes, they have it's. I won't even say it's 3 strikes. We typically will test the manager first, give them a separate account, let them trade their strategy. If it looks like they're doing what they said they're going to do, we go live, and then they're in the program. But if they deviate from what they said that they're going to do, or they break those risk limits, we typically have sort of a watch list that we'll add right away. That could be a red flag where we go to the manager directly and say, look, you're at strike 2 of 3. You only have 1 left. But we spend so much time with these managers, and we really believe that they're the best of the best. It would take a lot for them to put us in that sort of situation.
Okay, and final question is, my final question is, I'm losing my train of thought. From your perspective, from 3iQ's perspective, would you rather be growing the multi-strat or it doesn't matter if you get assets that are self-directing?
Great question. You're talking about on the platform itself, correct?
Yes.
Yes. So this is exactly why we built the DApp portfolio. So as we were going to market, and while Lou and his team were developing the platform and doing the diligence and interviewing managers for over 2 years, the business development team, we were pounding the pavement, developing partnerships and talking to investors to see what their struggles were, right? The larger allocators, right, want the flexibility. So there's a big enough ticket, and they want to work with 3iQ to build a customized portfolio and allocate to that. They can do that. We're talking to other, fund managers who want to allocate to single strategies, saying, I love that one, I want to add that to my portfolio. What they love about the QMAP platform is the risk managed aspect of it, and the fact that 3iQ is kind of overseeing all that. Then, as part of our mission statement, the simple remove friction, that's the DApp portfolio. So if someone says, look, you have 9 different strategies and I want to gain access, but I don't know how to put all this together, here are portfolios, and how do I just talk to my broker or talk to my banker and saying, wire money into that fund? That's what the DApp portfolio is. It's a simplified way to gain access.
Okay.
All the best of the best managers, but the investors that want to do a deep dive and want customization, we could do that. We're the only ones that could do that because of the managed account platform. So QMAP offers diversification and security and risk management. The DApp sits on top to create ease of access for the investor who just wants a simple way to come in.
Yes. So I guess where I'm getting to it, because we have a wide variety of listeners right now.
Yes.
That is really it's a more retail driven product. Is that fair to say, Pascal? I mean, for average Joe like myself that want to put in, $250,000, I'm not, I'm a bit of a novice in the space. I don't want to do anything crazy, but I want to ride the entire space. Okay, here's that.
Yep. Yeah, and we're exactly our feeder funds on the global scale. The one we're presenting is the
Right.
US feeder, but we're creating plugs, pipes and plumbings globally, ease of access, reduced, cost of entry, all those things. You're exactly right. And then someone who wants the bespoke white glove, show me all the strategies. Let's analyze the impact on my portfolio. We do that for the
Right.
the investors
So-
who want more of that.
So now I'm a billion-dollar family office.
Yep.
Looking to allocate 50 million.
Yep.
You will work with me to create a custom portfolio among the 9. Is that what you're saying?
That is correct.
And you welcome both kinds of money.
Absolutely.
Okay.
I was just going to say, John, one thing is it's not just the 9 and beyond that as well, because we have a universe of investable strategies. They're not all in a managed account for approval. But if someone came to the table with capital, we could actually do diligence for them on managers, right? Think of it more of almost like an OCIO style model where we can really help them across the spectrum, whatever they're trying to solve for, right? Because some investors will say, hey,
Okay.
we're looking for a very, very, very specific manager. That may not meet our criteria for the platform. It doesn't mean that we can't go in and kick the tires and see if they're a credible team or not.
Yeah, but Louis, that's your value proposition, right? You're
Yes.
screening through all the potential bombs out there. So why would somebody do that?
Because we'll help them stay from the next landmine. And we've done that before. We've looked at managers on behalf of outside investors and said, we would not allocate capital to them. So
Gotcha.
there's a lot of ways that we work with the sophisticated clients across our platform.
Gotcha. Okay. Thank you, gents.
Great
That's it for
questions.
me.
Thank you, John. No, this is great, and it helped to clarify the difference between the two. It's definitely what we're focused on is customization and flexibility while ease of access with the DApp.
Yeah, for our institutional clients that you will see, Pascal, they're going to go much more in depth with the
Yes.
type of questions I just asked you. So just a heads up.
Of course, we deal with them every day.
Yeah. John, great. I think those are great questions. A lot of them were some of the questions in the viewer Q&A. So I think we actually covered a lot of those. There are a couple of remaining ones we are running tight on time here. But a couple remaining ones I think were repeats I just want to address real quick. One, a lot of people are curious about who the managers are on the platform. So not sure if that's just something you want people to reach out for more information on, but you are willing to disclose the managers to interested parties.
Yeah, as we engage with investors and dive deeper into their questions, these are things that come up all the time. So we don't publish those openly, but we definitely talk about all of this and more in one-on-one conversations with allocators.
Great. And the last question, it would just be great to get the in-house 3iQ view on the market right now. What's the allocator's view on where we are in the cycle? Obviously, we've been chopping sideways for the better part of 3 months, at least in the majors. And a lot of uncertainty ahead of rate cuts, U.S. election, et cetera. I guess can be as high level as you want, but what's the 3iQ view on the market right now?
Maybe we have similar views, but from two different angles. I'll let Lou talk about he sees the data every day, and I'll talk about the conversations we're having on a global scale, and we'll let investors and watchers make a decision from there. But maybe Lou could talk about the choppiness we've been witnessing here.
Yeah, sure. I mean, so we're definitely in it's an interesting phase of the cycle. It feels a lot like a transition phase where things are slowly gearing up for that next move. So like if you look at the markets historically, the cyclicality of the markets, you always sort of see these periods of market exuberance. Then there's usually a correction consolidation phase. That's what happened in 2021 into 2022. And then 2023 in my mind was sort of the first leg of the recovery. In my view, though, the things that drive markets, especially the crypto space, it's really it's market liquidity, right? So an asset's only worth what someone's willing to pay for it. And when liquidity enters the market, especially in crypto, creates this feedback loop where rising prices start to attract more investors, and then that creates more liquidity, and that drives prices higher. And that's exactly how it's been played out in the last two bull and bear cycles. And so at this point in 2024, we haven't seen that significant inflow of new capital yet. And I think really need to see that before the next big upswing takes place. We obviously evaluate all the macro factors. Coming into this year, we were a lot more cautious than we were previously, just because we had an election year. We had sort of a Fed that was struggling and continues to struggle with whether they want to cut rates and how much. Inflation, whether it's sticky or not, hard, soft, no landing. These are all things that as an allocator, you say, okay, that's a lot of uncertainty. I'm going to take a step back and I'm going to play more of the neutral game. But we're starting to see positive things happen. For example, venture dollars. The last time that we saw this amount of venture capital money coming into the space was 2022. Crypto venture has been effectively dead since then. And you've actually probably seen a lot of that supply come out with these token unlocks. There's been this liquidity battle between ETFs that are pushing a lot of flow into Bitcoin, and then the altcoin world basically having supply unlocked and having venture managers say, look, I'm going to sell because I raised a bunch of money 2 years ago and I need liquidity to be able to justify my return. So I think it's definitely it's a wait and see, and we're cautiously optimistic, but we're starting to see really positive signs over the last several months. The market chop it's like nothing we've ever seen in the space, and that says a lot given how volatile markets have been. A down 30, up 30 market price swing in Bitcoin over 2 weeks is it's pretty hard to justify or explain why that happened. So that's my allocator's view.
I guess all I can add to that is more the qualitative side. Lou and his team really have a lot of the quant data on a daily basis, and our trading team as well. But on the biz dev side, on the qualitative side, the conversations we're having on a macro level with banks, platforms, regulators on a global scale, both in Canada, US, Europe, Japan, are all trending in much more faster and a more positive light than we thought. So right post FTX, I could tell you, and to summarize in 30 seconds, post FTX immediately after was, don't ever call me again. A year later was, I'll take your call in your meeting. I'm interested to learn more. And today we're getting the calls. And so that's what we've seen shift in the past 3 years. in 30 seconds or less. That's my take on what we're having. And the conversations are robust, accelerating in it's not just educational, it's actually accelerating towards opportunities, which is very exciting for the space.
Okay, well, time is up. I'm sorry, Sean, were you about to say something?
No, I was just saying it's a great response, and I just like the framework in terms of the nature of conversations from what was the darkest period in industry history to now what we have present day, where our biggest evangelist is really Larry Fink and BlackRock, and for better or for worse, people are getting on board, and people need solutions like the ones you guys are developing to ride the wave. So really great stuff today, guys.
Awesome.
Yeah.
Thanks, everyone.
Let the floodgates open. Pascal and Louis, really appreciate your time. We will be, and for our audience, we will continue to talk about 3iQ and the many different product offerings that they have. And we will have at least a couple more webinars before the year's over. So thanks for tuning in. And as I mentioned, any questions in terms of investing in their products or in the company for that matter, you could always contact me, Sean, or email us at inquiry@fundstrat.com or inquiry@fsinsight.com.